Welcome to Everyday Economics, a podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, president of the 501c3 nonprofit Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can check out all of our great podcasts at americastalking.com. To support podcasts such as this one, please make your charitable tax-deductible contribution by clicking the link in the show description. We're recording this episode on Tuesday, December 20th, and joining me as always is my partner, Dr. Orphe Divounguy. He's a PhD economist. I'm going to come right out of the box here and ask you a question, something that just doesn't seem quite right, even I think to people who do pay attention to markets. But the Fed rate, which has just recently gone up another half a point, and the mortgage rate, the average mortgage rate, Fannie Mae, boy, they seem to be going in different directions. So why are mortgage rates coming down? And they're down almost an entire point in the past month.
That's a very good question that I'm getting a lot lately as well. So like a lot of people are asking, like, what's going on? Or where are mortgage rates going? Why are they coming down and where are they headed? And I got to say, look, it's really, really difficult to predict where mortgage rates are going to go. Economists don't have a crystal ball. This is very difficult. But historically, here's what we know. The 30-year fixed mortgage rate tracks the yield on 10-year treasury bonds. And that 10-year yield has been coming down. Long-term interest rates, right? So the 10-year, the 30-year mortgage rates really reflect both current economic growth and inflation, but also the risk associated with future inflation uncertainty and the future path of interest rates and the economic outlook. In other words, investors don't just look at today, they care about the future, they're forward-looking. They have to be compensated for bearing the risks associated with future inflation and changes in interest rates, right? And the economic outlook. And so mortgage rates coming down, well, the yield on the 10-year treasuries coming down reflects the fact that inflation is on the way down. People are starting to say, hey, hold on a second, inflation may have peaked. If you pay attention to the headlines, hiring is slowing down. Layoffs are still low, which is a good thing, but hiring is slowing down. And economic growth seems to be stalling. People are thinking, okay, well, 2023, economic growth may actually stall. And if economic growth stalls, right, if we all bearish about the future, the markets will think, okay, well, maybe we should spend less, save more. All right, if demand is expected to decline, businesses will invest less. And then when you have too much savings looking for too few investments, the real cost of borrowing for a new project falls. And so the interest rate starts to decline. If that 10-year yield starts to decline, you're likely to see mortgage rates decline as well.
Do you feel that is what we are seeing, that we're seeing maybe the beginning of this? I mean, I'm just trying to pick some stats here. And of course, the rates are different all over the country. I'm looking at
That's
it from
right.
the standpoint of Illinois. 30-year fixed to today, 7.114%. Going back to like November 9th, that number was more like 7.9.
Yeah, I mean, on average across the U.S., you're looking at 7.1 in November 10th, down to 6.3 December 15th. So as mortgage rates decline, you see mortgage applications increase. And again, justifying my thesis, which we've talked about on this podcast many times, that there are a ton of home buyers waiting in the wings, right? We're seeing this decline in housing market activity, but there's a lot of people that were outbid in 2021, and then they got into 2022 and housing was just unaffordable because mortgage rates had soared. Well, they're just waiting. They're waiting for their time. They're waiting patiently on the sidelines for mortgage rates to decline, for affordability to improve, to jump back into this market.
I could offer anecdotally, simply, we were trying to buy a house this spring. It was exhausting. Not multiple offers in the conventional sense of like 2 or 3, like 14 or more on the first weekend of showing. Houses coming, into the market and being placed under contract in a matter of like 48 to 72 hours. Frankly, the stress of that, that was a big signal. Like, this just doesn't make any sense. We stepped out. Now, going back in and thinking about buying a house now is a little less palatable simply because of where mortgage rates are. So I'll ask the question that the people who have, like me, who have stepped out for now, where do you see rates and prices being favorable to the buyer?
I never like pitting buyers and sellers against each other because we know from research that 70% of sellers end up buying again. Sellers are buyers and buyers are sellers.
Yes, exactly right. But I'm feeling make me feel better on the buy side.
So here's what's going to happen, right? You want to sell your house. You're probably locked into a very low mortgage rate right now. And so you're just like other buyers as a seller are waiting for mortgage rates to decline. You're waiting for that decline in mortgage rates so you can get rid of your golden handcuffs and then move into a new home that you've kind of been waiting for in 2021. Mortgage rates, yes, I really believe that it's more likely that we're going to see an improvement in affordability coming from a larger decline in mortgage rates than we're going to see affordability improved from price declines. And it's because, we know inflation's coming down. We know that sellers are going to sit tight and wait, which of course puts upward pressure on prices. And so even if a price decline is expected, I think affordability improvements will come more from the fact that mortgage rates are coming down. Mortgage rates are coming down again because inflation is coming down, but also the economic outlook, right? Hiring has slowed. Most people expect economic growth to be really, really low in 2023. And hopefully, and layoffs, by the way, it's important. Layoffs remain low, it's really important because people don't go out and buy houses when layoffs increase, when the unemployment rate soars, right? If you lose your job, you're not going to go out and try to buy a house. So it's important that we see this, I would say, softer landing to mild recession, right? It's important that we don't see a severe contraction because if we see a severe contraction, all bets are off. I'm optimistic, though, going into 2023. I've called a few things in my years, but, I think I might do well in 2023 on this one.
Well, as always, I appreciate your insights and, we will start scorecarding your called shots in 2023, so we'll be able to hold you to account, sir. For Dr. Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other quality podcasts at americastalking.com.